Okay, we will have all the things what we have done before, plus we will have something related to portion of unrealized profit. Okay, we have something related to portion of unrealized profit. Now, we have done here. From here we have to start. Is it right?
Yes.
Is it? From here we have to start. Now what they are saying here, see the thing. Health bought 90% of the equity share capital 2 years ago. Okay, 2 years. Means if there is any depreciation is there, we have to take 2 years. Immediately what you have to do, you have to put the group structure. Is that immediately you put the group structure, working one. Okay, how much is there? Health is there. Okay, health is there. How much it is going to be happen? It is going to happen with respect to safety. Is it? It is safety. When they have bought it on 1/1/2002. Okay, 1/1/2002. How much they have bought it? 90%. When the retained earnings, how much was the retained earnings? Retained earnings is going to be 5,000 at acquisition. Okay, at acquisition. Okay, statement of financial position, fine. Okay, this is very simple. Okay, this is very simple. Now, what they are asking us, they are asking us to, they have the safety transferred goods to health. What is the transfer price? 18,000. What is the markup? 50%. 2/3 of these goods remain inventory, unsold at the year end. Okay, the payables, and this is another point. The payables and receivables stood at 22,000 on day. Goodwill has the impairment of how much? 10,000. Health uses fair value method to value NCI. The fair value of NCI is how much? 4,000. Prepare the consolidated statement of profit and loss, financial position. What we have to do first? Are we clear about this? The
Yes.
first one, okay, simple. What is the second one?
Net assets.
Net assets. Net assets of subsidiary. Okay, at acquisition, at reporting date, post acquisition. You don't need revision for that, trust me. You don't need revision for that. That much we became perfect here. Okay, that much we became perfect here. Next, what is there? How much is the share capital check?
Five.
How much is the share capital? Share capital is 5. Mostly,
Five.
till now we have not seen any time that the share capital has been changed. Okay, retained earnings. They have made it. Here we have retained. How much is the retained earnings? Retained earnings is also 5,000. Are you clear about this?
Yes.
How much is the retained earnings at reporting date? At the reporting date, how much is the retained earnings here?
31.
31. Okay, it is how much? It is 31. How much it has been increased? 26. Is it okay?
Yes.
This is 10. This is 26. Basically, we have to take first and last column. This is 36. Okay, this is 36. Now it is how much? 10. It is 26. Are you clear about this? 1 minute.
Yes.
1 minute. 1 minute. No. Is it right? 1 second. We have to wait. Okay. Now, what is the portion of unrealized profit is there? Portion of unrealized profit, how much is there? Portion of unrealized profit. How much is there here? 18,000. Is it right? I am writing here only. Okay, PUP. Okay, PUP. This is working. We will give you the working number. Okay, we will give that. We have to deduct the Unrealized profit. How much is the sales? Sales, take the same thing. Sales is how much? 18,000. This is 18,000. Understand my point? I'm putting underline means take it as 18,000. Okay. How much is the markup is there? How much they are adding profit?
8.
How much they are adding profit?
50.
50% means 50 by 150. If, see, this is the shortest route. If the markup is 50% means 1 by 3. If the markup is 25% means 1 by 4. Is it 25% means 1 by 5? I will tell you how we have to do it. Separately I will tell this. Okay, how much is the markup? Markup is 50%. How much they have unsold? They have unsold 2/3. Are you clear about this?
Yes.
How much you will get?
$4,000.
4,000. Unsold. How much is the 4,000? This is thousands. Okay, this is thousand. This is the profit on portion of unrealized profit. Okay, portion of unrealized. This portion of why we are deducting is here. See what is happening? Safety. This is the subsidiary transfer. Understand what? Subsidiary has been transferred goods to health. If the subsidiary is transferred goods to parent company, then what we have to do? We have to deduct it from the subsidiary. Understand what? We have to deduct it from where? We have to deduct it from the subsidiary. How much you have to deduct it from the subsidiary? 4,000. Are you clear about this? Here it has been mentioned. Just I want to make sure. If the seller is a subsidiary, the element of subsidiary retained earnings and the relates party relate to what? Related to the NCI. Is it? If the subsidiary is a seller, if the seller is a subsidiary, what we have to do? We have to deduct it from the net assets of the subsidiary and proportion of unrealized profit. Here they have mentioned very clearly. What they have mentioned? Safety, transferred goods to health. Safety is a seller. Is that safety is a seller, and the health is he is the purchasers. We have to make sure that this is another important point. We have to be very cautious. Who is the seller? Who is the buyer? Is it okay?
Okay.
Okay. This is one additional point we are doing. This is the one additional point we are doing. How much is there? It is 10. Is it right? 31, 36, 32. And how much is there? 22. Is it okay?
Yes.
Okay. This is one point we are doing. Wherever we are doing new point. Okay. Wherever you are doing the new one, I will put it as a green mark. Means assume this is the first time you are doing. Okay.
Okay.
Okay. That much. Okay. This we will take subsequently in the next stage. Okay. This we will take subsequently in the next stage. This we will divide into parent and subsidiary. Now, what is the next one we have to do?
Goodwill.
Goodwill. Same steps. Okay. Same steps. Goodwill. How much is the cost of investment? What is the cost? They have mentioned anything cost of investment? If they have not mentioned cost of investment, then whatever is given here, we have to take that one. If they have not given cost of investment, whatever the value is given here, we have to take that one. Okay?
Okay.
Cost of investment. How much is the cost of investment? Cost of investment is 34. What we have to is in dollars. This is in thousands. This is in thousands. Next, what we have to add?
NCI at acquisition.
NCI at acquisition. How much is the NCI at acquisition? How much they have gave you? The fair value. The fair value at NCI acquisition is how much?
Um, 4,000.
4,000. Okay. NCI acquisition is how much? 4,000. Okay. Next, how much you will get? 38. What you have to do next?
Minus net assets at acquisition.
How much is the net assets at acquisition?
Then
Good. How much is the goodwill?
correct.
How much is the goodwill? 28. Is it there?
Yes.
Next, what you have to do? What we have to do?
We have to minus this.
What?
Unrealized profit.
Impairment. Goodwill impairment is there, point number 1. Last line.
Yes, 10,000.
You have to be good. Little bit you have to pick up the speed. You have to pick up the speed. Okay? Impairment of goodwill. How much is the impairment of goodwill? Impairment of goodwill is 10. How much is the goodwill? 18. Are you clear about this?
Yes.
Consolidated statement of financial position. Is it okay?
Yes.
Next. What you have to do next? Working 3.
No, 4.
Working 4, yes, sorry.
NCI.
NCI. How much is the NCI at acquisition? We have calculated, given now. Point number 2. Fair value at NCI. Point number 2, last line.
4,000.
4,000. Okay, point number 2, last line. Now, what we have to add to this? Add or less?
Add shares.
add share of post acquisition profits. How much is the post acquisition profits? 22. Yes.
Yes.
What is the percentage of NCI? 10%. Is it okay?
Yes.
It comes to how much? 2.2. Is it okay?
Yes.
What you have to do next?
Minus shares of goodwill impairment.
Share of goodwill impairment. How much is there? 10 times 10%. It comes to 1.00. Are you clear about this?
Yes.
Okay. How much you'll get? That's all. Nothing is there. 4, 6.2 minus 1. 6.2 minus 1, 5.2. Check. Is it okay? Is it fine?
Minus 4 plus 2.2 minus 10.
Minus 10 not there. Sorry, it is not minus 10. 1, 1, 1. 1. It is my mistake. 1. 10, 10, 10,000, 10,000 in times 10%. How much is the goodwill impairment? 10,000. Yes?
Yes.
10,000. This 10,000 should be 90% and 10%. Is it okay?
Yes.
Next. Are you understanding how we are doing?
Yes.
Simple. Okay. Now I will not leave space for you to say that it is tough. Okay. I will not give that opportunity for you to say that it is tough. How much is the retained earnings? This is the health. This is the safety. It is a 10%. It is a 90%. What is the retained earnings? How much is given here? Retained earnings. How much is there? $159.
159.
Okay. Now in 159, we have to add? We have to write a share of post-acquisition profits. How much is the post-acquisition profits? 22 multiplied by 90%. How much it will come?
19.8.
Next, what you have to do?
Minus share of goodwill impairment.
How much is the 10 times 90%? Are you clear about this?
Yes.
How much you'll get? $159.0, 19.8 minus 9.
169.8.
Are you clear about this?
Yes.
Little bit. You have to be. Now the first stage is over. Now the second stage is you have to be little bit fast. Time is very important. Now you have to focus on time management. If you are good in subject and not good in time management, nothing will work. Okay, now slowly I am telling you in advance that now I will put some for to do it quickly. Okay, do it quickly. If you do it here, if you are doing here in 1 hour in examination, you will take 1 hour 10 minutes. Keep it in mind. So in examination, definitely the time will be needed more. You have to manage it very perfectly. Are you clear about this?
Yes.
Okay, little bit I will ask you to work it out in a very quick manner. Okay, here
Okay.
here I'm telling you in advance. Okay, here we will do the statement of consolidated statement of financial position as at. Okay, as at when we have to do it, 31st December. Okay, 31st December 2003.
2003.
Okay, now non-current assets. Is it non? Because what will happen in, you have to understand, you have to work it out, you have to review it. So many things will be happen. That is the reason you have to be little bit more quick. Okay, in non-current assets. Okay, what we will write? The first one we will write is what?
Goodwill.
How much is the goodwill?
18.
80. Property, plant and equipment. How much is the property, plant and equipment?
100.
30. 100 plus 30. Why you will miss subsidiary? You have to take subsidiary. Okay? 100 plus 30. Are you clear about this?
Yes.
Next, current assets. We don't have anything. Only the unrealized profit, we have to remove it. Okay? In inventory. Okay? Unrealized profit, we have to remove it. Is it right? How much is the inventory? Inventory is 90 plus 20 minus 4. Is that this is portion of unrealized profit. I have not written that. I have waited here. I will put it as a working 6. Are you clear about this?
Yes.
Okay, working 6. How much is there? Minus 4. It comes to how much? 90 plus 20, 110, 110 minus 4, 106.
106.
106. Okay, trade receivables. How much is the trade receivables?
110 plus 25.
110 plus 25. Anything is there trade receivables? Point number 1.
Yes. Yes, of the transfer.
22,000. It is there?
Yes.
22,000 you have to remove from payables, you have to remove from receivables. Okay, you have to remove from if you are removing from receivables, you have to remove from payables also. How much is there? 120, 135, 135,
113.
113. Very quick. Is it right? Now subject is not important. Time is important. Okay, till subject is important, I was very slow. Next, cash and cash receivables, cash equivalents. Now, from next week onwards, you have to open a Word file and you have to do in the Word file and Excel file. I will tell you how to do that. Okay, I will tell you how to do that. Okay, in the end, with the moment we start examination kit, I will also tell you how to do that in examination. How to set the screen. One is the question, one is the Word file, and one will be the Excel file. How much is the cash equivalent? 10 plus 5. We don't have cash in transit here. Is it right? How much is the total? 18 plus 130 plus 106 plus 113 plus 15.
382.
How much?
382.
Good. This is the total assets. Is it okay?
Yes.
Equity and liabilities. How much is the equity? Check. Equity. We have to take only equity of parent company. Okay. Okay, you have to take equity of only parent company. Next, what we have to take? Retained earnings. Is it right? How much is the retained earnings?
150.
We have calculated now. What is the retained earnings?
169.8.
Yes. Next, NCI. How much is there? Working for?
CR is 5.2.
5.2. Add it 0, 1, 11, 2, 8, 9, 191. Check.
One nine zero.
190, sorry. Okay, this is total equity. Fine. Next. What is the non-current liabilities? How much is the non-current liabilities? Take both the companies, okay? But only we should not take equity, that's all. Equity and return. 120 plus 28. Only we should not take equity and a cost of investment. 128 plus 28, 148. Okay, current liabilities. Again, we have to remove in the current liabilities. Okay, how much is there? 50 plus 16 minus 22. Are you clear about this?
Yes.
How much we'll get? 66. 66 minus 22, 44. Check.
Yes, 44.
0, 2, 1, 9, 292. 0, 2, 1, 10, sorry, 281, 382.
382.
Are you clear about this?
Yes.
What is the total we got assets? Are you clear? Is this okay?
Yes.
Now from almost, now only thing is mid-year acquisition, that is not a big thing as such. Once it is done, please.
Practice, but it would be.
Huh?
More practice, it would be perfect.
It is simple piece of cake. Every paper is like this only. Trust me. Only thing is you should not have shortcuts. You should not, without steady text, you should not touch revision kit. That is the only rule. Is it clear to you?
Yes.
Have you completed writing?
No, 1 minute.
Either today or tomorrow we'll complete this. Once we are complete this, then we will straight away We'll straight away go to the next one. Major part is over.
Okay, done.
Okay? Now, what is they? See, they are talking about so many things. If one group sells, is it? If one group sells non-current assets to another, adjustment must be made to recreate the situation that it would have existed if the sale has not occurred. Means if you are selling one company is selling to other, we have to assume, we have to recreate the situation that sale has not occurred. Means we should not treat it as a sale. There would have been no profit on the sale. Depreciation would be based on the original cost of the asset to the group. Okay, if you are going to transfer, okay, by selling or transfer non-current assets, okay, non-current assets, then we should not treat it as a sale, and we have to combine it, and we have to calculate the depreciation as normal as we are doing. Okay, as normal as we are doing. Is that any profit on sale that is made selling entity is any profit is unrealized profit and eliminated as we are eliminating with the inventory. Okay, with respect to non-current assets, we should not treat it as a sale, as simple as that. Unlike inventory, which is usually sold shortly after the reporting date, goods that became non-current assets of the receiving entity are likely it will be included in the statement of financial position. For whatever the number of years, we have to divide it by the number of years depreciation. Where there means, what is the message? Very simple. If it is non-current asset, you should not treat it as a sale. As simple as is that you should not treat it as a sale. Is it? You should, and we have to calculate depreciation normally. Where there is an unrealized profit on non-current assets, and the necessary reduction in non-current asset will reduce the non-current asset is depreciated. If you are reducing the value of the non-current asset, then we have to treat it as a depreciation. Therefore, portion of unrealized profit should be recalculated at the end of each period in which assets appears on the consolidated statement. Means what is if they are talking about non-current assets, don't treat it as a don't treat it as a inventory. Inventory is different. This is different. Inventory you can have unrealized profit because unsold inventory. Here, when we are talking about the sale of NCA, we are not going to sell a non-current assets 20%, 50%. We are going to sell how much? We are going to sell totally 100% value. Then if there is a 100% value, then we should not treat it as a profit also. Straight away you have to take in the consolidated statement of financial position, and normally we have to treat it as a depreciation. Okay, normally treat it as a depreciation. Is it clear to you?
Yes.
Okay, the easiest way to calculate adjustment, to compare the carrying amount of the asset now with the carrying amount, it would have been if the transfer never occurred. This is the simplest method. Don't assume transfer has not happened. As simple as that. Assume transfer is not happened. Non-current assets. Carrying amount, we have taken the carrying amount. We have taken the depreciation with the transfer, without transfer, portion of unrealized profits. Carrying amount, we will take the difference and we will take this one. What they say, the net PUP should be deducted when adding across parent and subsidiary. For the net PUP, this amount, okay, this whatever the amount you will get, that amount should be deducted. The profit on transfer should be deducted from the reserves, means from the retained earnings. If reserves are not given, then you have to take retained earnings. Which company? We have to take the selling company. Subsidiary. If it is selling company, if there are any profits, you have to deduct it from the subsidiary working 2 and the parent working 5. Whatever the difference you will get, that is going to be treated as a depreciation. Here a little bit, unless until we don't do the problem, we will, with theoretical statement, we will find it little bit more specific. Any excess depreciation charge against buying entity profit should be added to the, if there is any excess depreciation, we have calculated, is a charge against the buying entity profit. Any excess depreciation, we have to add back to the reserves. Any depreciation, we have to deduct it. If there is any additional depreciation, deduct it from the reserves. If there is any additional excess we have calculated, you add back. The adjustment to the subsidiary reserves working 2 will then affect the post-acquisition profit. Definitely, the last column will get affected and effectively shared between what? Shared between parent and non-current controlling interest. Okay, now what is, you should be very clear. Working 2 is net assets, subsidiary. Working 5 is the retained earnings. Is that you have every, working 3 is goodwill. Working 4 is NCI. Is that you have all the things that is there in your mind. Is that working 6 is portion of unrealized profit. Okay, maximum 6, or if you go for the fair value adjustment. Okay, if you go further, there will be a fair value adjustment. 7 adjustment. Keep it in mind. These 7 workings. Okay, working 1 to working 7. When you are revising it, make it clear. And we have to do this in the sequential manner. Don't worry about the financial statement. These workings has to be right. If these workings is right, minimum you will get straight away. You will get minimum 9 marks. I will say, is that minimum 9 plus you will have another 9 plus you will have 2. Almost 20 marks is there. I am giving you a lower side. Okay. If you take into account, it may be 11 to 12 marks also what are working. That is the reason. Working, you have to be very specific. Are you clear about this?
So section 3, 2 questions, each 20 marks.
Each 20 marks. See, before you enter, I will prepare you mentally. Psychologically, I will prepare you. That section A this, section B this, section C this. Whichever it is easy, I will not ask you that. Whichever it is easy for you, you go. Don't plan. You go. Reading time will be there. Just make it a point. In that reading time, you decide what are the easy questions, what are the first and foremost, do the easiest one. Our target is first you have to reach 50. If you want to reach 50, you should make sure. Okay. Then whatever is happening, inshallah khair.
Inshallah.
Okay. This every exam it should be like this. Okay. It will work. Now, they are talking about the illustration. Okay. Illustration, I will not take that much time. Okay. Unrealized profit in non-current assets. Whatever say they say, if it is a non-current asset, treat it in a normal way. Treat it in a normal way. Difference, what is that they have mentioned very clearly. Any difference, excess in anything it is there, it is anything we have to it has to be deducted from the reserves of the selling company. Anything excess, we have to add back to the reserves. We have to add back reserves to the buying company. Okay, this is what we have to make sure. Now, what is the P acquired? P parent company acquired 80% of S number. Yes, subsidiary, number of years ago. They transferred an item of plant, 6,000. The original is how much? 10,000. Original life of the asset is 5 years when purchased. The original life useful of 5 years when purchased 3 years ago. Means how many years are left over now? Remaining how many years?
2 years.
2 years. Original life is how much? 5 years. Purchased 3 years ago. Remaining years, 2 years. The useful life of the asset not change. Okay, the useful life is remain almost 5 years only without transfer. Okay, what is the unrealized profit? What is the unrealized profit? We are only talking about the plant and machinery. Okay, which should be treated. How much is the value? 10,000. They have calculated depreciation for 3 years. How much you are getting carrying amount is 2 years. Depreciation is a depreciation. Now what is happening? This is very important. This is very important. What they have said, uh, depreciation. The overall adjustment will be 1000 reporting day, comprising 2000. The initial profit less 1000 excess depreciation. Huh? Is it right? Now what they say? They say that huh, 10,000 minus 6,000. Carrying amount is how much? 4,000. Depreciation is how much? Depreciation is without transfer. Okay, without transfer means the original one. Okay, without transfer means with the original one. Is that 4,000? This is for the 3 years. Okay, this is the depreciation for the 4th year. Okay, this is the depreciation for the 4th year. This is the carrying amount for the 4th year. Are you clear about this?
No.
Normally, we are not doing anything. This is the carrying amount. Purchase price is 10,000. Depreciation for 3 years is 6,000. Carrying amount is a current year depreciation. Current year depreciation is 2,000. Carrying amount is 2,000. Are you clear about this?
Yes.
With transfer. Okay, with the transfer. With the transfer. How much they have transferred it? They have transferred it for how much? 6,000. Is it right?
Yes.
Is it? They transferred it for 6,000. Okay. Now on the transfer, they have calculated depreciation 3,000. Is it there? 2 years depreciation. Is it right? 6,000. 6,000 divided by remaining 2 years. 3,000 is there. Okay. 3,000 is there. Carrying amount is how much? 3,000. Is it? Difference is how much? Difference is 2,000 is the excess. You have the depreciation. Is it? Depreciation is how much? We have to calculate depreciation, revaluation amount. When you are doing the revaluation, you calculate depreciation on the revaluation amount. 1,000. Is it there?
Yes.
Carrying amount is how much? 1,000. Fine.
Fine.
Okay. Now in the retained earnings, yes. Tell me.
No, nothing. I'm saying okay.
Okay, in the retained earnings, what we'll do, we'll deduct 2,000. That plant and equipment is how much? Plant and equipment is 1,000. Because who has transferred this? Is it right? It has been transferred. P transferred plant, P acquired S limited, and P transferred an item for to S limited. Okay, how much is there to the S limited? So P has transferred. Okay, P has transferred. Property, plant and equipment will be decreased, and because P has transferred in the P account in the consolidated statement, how much they will deduct excess depreciation, because actually the depreciation is 2,000. But what will happen? They have on the revaluation amount, they have calculated on the 3,000. There is a difference of how much? Still they have to deduct depreciation. Are you clear about this?
Yes.
Little bit. We need practice on this. The impact of subsidiary retained earnings above in working 2. Okay, the impact of subsidiary retains the impact on the working 2 is that NCI will be debited by how much? Okay, NCI will debited by 20%, and the parent company will be deducted by how much? 80%.
80%.
Okay, this is going to be 80% and 20%. Is it okay?
Yes.
Okay.